And hi, David. Hi, Ian. Great to see you again.
Likewise.
Thanks for joining, and I'm pleased to be here myself. So we'll start off with brief introductions. I'm Tom Zuber. I'm the managing partner of Zuber Lawler. We're a law firm headquartered in Los Angeles with 7 offices throughout the United States and reach throughout the world. We do a lot of work with Fortune companies, financial institutions, and government entities, and we do an awful lot of work with REITs, family offices, funds, and so forth. That includes deal work, it includes regulatory work, it includes lots and lots of litigation. And so I'd also like to introduce my esteemed colleagues. First, Ian Selig, of course, who many of you have just heard from. He's AVP over at Safehold. Ian, for those of you who are just joining us for this portion of the broadcast, do you want to go ahead and reintroduce yourself?
Sure. Again, my name is Ian Selig. I am the AVP of Investor Relations over at Safehold, as well as iStar. I kind of just went through the Safehold story, but we are literally revolutionizing real estate ownership with our modern ground lease capital solution. We have been a public company for 4 years now, and as I just mentioned, we have been the #1 performing NAREIT member stock over the last 2 years. And it's really a delight to be with both of you folks today. I think we're going to cover a lot of good ground.
Thanks, Ian. And David Auerbach, he's over at World Equity. He's an institutional trader. David, it's a great pleasure to speak with you again. And could you go ahead and, for the audience to say, give a brief introduction of yourself?
Sure. Thanks, Tom. Good to see you, Ian. I'm a longtime 20-plus year Wall Street sell-side institutional trader with World Equity Group. I'm a consultant on behalf of Unrealized. I'm also the publisher and co-author of the daily REIT Beat newsletter. It's a daily/weekly publication that goes out covering pretty much all 180 publicly traded equity REITs, covering the major news stories, ratings changes, headlines, news articles that are out there. And it's a widely followed publication across Wall Street.
Thank you, David. And David, why don't we stay with you? We'll give Ian a breather. Ian, very nice presentation just now. David, of course, the world's immersed in COVID. We see some promising signs here. The world's starting to come out of, obviously, this COVID slumber, but at the same time, these variants are awfully scary. But I think overall, the trend is that things are reopening, and with a hiccup here and there, I think that pace will hopefully continue, I'll say. So on that note, how is the REIT sector participating in this wave of COVID reopenings?
Well, I mean, Tom, if you look at the event that we're having part of today, the Benzinga Reopening Stock Summit, it's really the Benzinga REIT Conference, since we've seen so many REITs participating with this reopening. And I think as we're getting back to what I call normal, what you're seeing is everything that was shunned last year has actually become very popular this year, as far as let's go back to the hotels, let's go back to the office, let's go back to the mall. And so you're basically seeing all those sectors that were shunned during COVID are being re-embraced. One particular name that was really under the pressure for much of COVID was EPR Properties. We used to call it the old entertainment properties, but the ticker is EPR. EPR is known as the movie theater REIT. They have 177 movie theaters out of their 283 properties of their experiential portfolio. Well, during COVID, guess what? Movie theaters were closed. And so this company was really going through the doldrums. Okay, now let's look on the other side. Not only are the movie theaters reopening, but EPR also happens to be one of the partners and exclusive developers of a small concept called Topgolf, which is owned by Callaway. And so if you know anything about Topgolf, these interactive driving ranges, they're trying to find a way to, again, bring all about the experience. So as we're getting out of COVID and trying to go back and focus on these experience type events, whether it's going to the movie theater, going to the driving range, going to the ski resort, to the water parks, amusement parks, indoor skydiving, they're just focusing on all the things that you basically can't replicate online. I'm sure you can watch, stream Black Widow on Disney, but you can't go out to the lobby and get yourself some snacks like you can at your own kitchen. So I think that EPR is a perfect example of a name that was just getting so hammered during COVID. But if you want to think about something coming on the other side, could be a great way to play the reopening trade.
And how is World Equity participating in all of this?
Sure. So World Equity Group is a broker-dealer based out of Chicago. It's a very multifaceted company, including investment banking division. There's a pre-IPO side of it. We have an IPO fund working with a lot of the issuers. And so my broker dealer and I, we're working with a bunch of the companies that are actually out there reissuing securities. So as Ian, knows from his side, capital raising is very in vogue right now across the REIT sector. I use this analogy, and I really haven't heard a lot of the guys talking about this over the past day or so. But the reason being, REITs proxy is the 10-year treasury. The 10-year is trading, let's say right now, just on average, let's say 1.25%. According to NAREIT, the average dividend yields right around a little sub 4% right now. Call it 3.984%. So you basically get about 275 basis points in your pocket to be out there acquiring real estate. And then another sector that my partner and I focus on is really looking at the preferreds. And so if you start trading the preferred stocks, you can add about another 100 to 200 basis points on top of that. So again, the difference between buying real estate versus buying the 10-year treasury proxy, you're getting about 300 to 400 basis points in your pocket. And so we're trying to help a lot of these companies that are issuing new preferreds or new securities go out to the community and tell them, hey, here's why you need to be looking at this particular security.
Thank you, David. So staying on this topic for a moment, what REIT sectors have been most affected by COVID-related reopenings? We touched on EPR, we touched on Topgolf, but sectors in general, what sectors are most affected?
I mean, if you look at the sectors that were actually hammered during COVID, it would be office and the mall properties, hotels. Those were the three biggest sectors that really took it on the chin. But what actually thrived was the guys like the data centers, the towers, the work from home trade, because look, we're sitting here on a Zoom as an example. That's being powered by way of the towers and the data centers. So there was the winners and the losers during COVID. And what you're seeing right now is, granted, the data centers, the towers, those guys are still doing well, but you're starting to see like office guys improve. Like a great example in Ian's backyard is SL Green and their One Vanderbilt. SL Green opened One Vanderbilt right in the middle of COVID, and just now they've hit over 90% occupied. They had said they were looking to get 75% occupancy by the end of this year, and I wouldn't be surprised if they hit 100% occupancy. But if I told you a year ago in the middle of COVID that fast forward a year, would you guys believe that you're going to be at 100% occupied by December of 2021? They would have thought I was smoking crack. So a lot of these companies, again, that were just so destroyed during COVID are now actually the darlings. A great example is Simon Property Group. Go look at what happened in the mall industry during COVID, and now look what's happening on the other side. Simon closed their merger with Taubman. They're focusing on more experiential type concepts, similar to what EPR is doing. And so a lot of these guys are looking at the other side saying, we've learned our lessons, we took our punches, but now let's become leader and meter and focus on the next time. Meaning, okay, we had COVID last year. Well, now we have Delta and Lambda. What did we learn during COVID last year that we can take to benefit this year in Delta and Lambda? And what you're seeing is the guys aren't closing their properties. They're just enforcing different measures that are in place. But then the question is, well, what happens if we continue to spiral? And I think a lot of these management teams are like, bring it on. We've been there, done that. We're ready. Case in point. And then I'll let Ian speak. Case in point. Go read every single mall REITs transcripts from this past quarter. And all they'll talk about is, sure, COVID, that's great. We've been leasing. These guys are out there leasing a ton. So there is huge demand for people to go into these properties, whether it's a strip center, an office building, a mall property. A lot of wheeling and dealing is happening. It's a good time to be a deal maker right now. And I'm sure Ian's guys with the Safehold side would tell you the same thing.
Appreciate that, David. And on that segue, let's go ahead back to Ian. So Ian, fabulous presentation again. For the sake of folks who are just joining us now, go ahead and tell us, what is a ground lease?
Sure, Tom. And by the way, I don't think I can hammer this home enough, because to understand the structure of a ground lease is to really understand our business. So the structure of a ground lease is relatively straightforward. Any piece of commercial real estate is literally just two components. It's the land and it's the building that sits on top of that land. And in a ground lease structure, we separate those components, and one party owns the land, and that would be us at Safehold, and another party leases that land for a long duration, typically 99 years. The tenants of that building are, in effect, the owners of that building. They're responsible for all expenses. They're under a triple net lease, meaning that they have to pay the taxes, the maintenance, the insurance. They have to pay any capital expenditures. But any net operating income or profits that that building produces is theirs to keep. However, at the termination of a ground lease, not only does the landowner, in this case Safehold, get the land back, but we get the building and all its improvements back as well.
Thank you. Very helpful, Ian. And I know that Safehold is doing some pioneering stuff in the area of ground leases. So can you tell us a bit about that? What is Safehold doing differently with respect to ground leases?
Sure. So, I mean, the idea of separating the land from a building via a ground lease has actually been around for centuries. And over that time has really proven to have been one of the greatest wealth creators for a very elite group of landowners, primarily churches, universities, royal families, and other enduring institutions. But quite candidly, these ground leases of the past have had less than a stellar reputation, because most of these old-fashioned archaic ground leases contain negative provisions such as arbitrary rent resets, required permissions for just about any improvement, and were really written to be extremely one-sided toward the landowner, which would make these leases value destroying for the building, not value enhancing, and created two things, as I mentioned earlier, that the markets despise, which is uncertainty and ambiguity. So at Safehold, we recognize that the problem is no one has taken this fundamental idea and modernized it to work in today's capital markets. So we stripped away this unpredictability and made our ground leases both customer friendly and lender friendly. Safehold's thesis is basically to understand that anytime someone buys a property, they're really buying those two things. They're buying the building and they're buying the land, but they are very, very different investments. And as I mentioned earlier, the building is the higher return operating part of the business, where all the leasing, marketing, managing needs exist, and it makes it a very active investment. The land, conversely, is the quiet, passive, lower return part. I think a good proxy is a long-term, high-grade bond. And the truth of the matter is, as I mentioned earlier, there's really no other place in the investment world where those two types of investments are forced to be together. We use the examples, you don't have to buy the bonds of a company to buy its stock. That would be silly. So, but that's kind of what's been happening in real estate, because there's never been a nationally scaled institution, and that has investment grade credit ratings, by the way, to acquire that land component and do it in a way that actually enhances the value of building. And that's our value proposition. The math is very compelling for building owners. We really have built a better mousetrap here at Safe.
And Ian, you've implied, but if you could state expressly, I'd appreciate it. How are Safehold's ground leases friendlier to building owners, and how is it enhancing return for building owners precisely?
Sure. So the first idea, for building owners, we've created three really important efficiencies. So the first is a capital efficiency, because as I just mentioned, since the building and the land are really two separate investments, they really should be capitalized separately, right? So there's clearly an upfront capital savings. If you wanted to buy a $100 million building, well, you could just put out $65 million. Let me buy the land for $35 million. So not only are you saving upfront capital needs, but more importantly, you're not taking out a $100 million mortgage, obviously less equity. You're taking out now a $65 million mortgage. So, and by the way, and as you know, Tom, probably better than anybody else, and David as well, is that's how most folks go out of business in the real estate world. When that bullet comes due, it's a lot easier to get out of a $65 million bullet than a $100 million bullet. But I think more importantly, and so that maturity risk reduction, so just to put a period on that statement, is probably one of the most important pieces of what we're doing at Safe. So they are generating higher returns with less risk. It's very, very simple. And if you put the metrics of a deal of a building fee simple, that same $100 million building, versus with a Safehold ground lease, you will see the return profiles are much better with less risk within a ground lease structure. But for our investors, there's really two components of value. First, because our ground leases contain these 2% annualized compounding bump structures within them, we generate excess returns for our investors when you put them next to similar investments with similar risk and maturity profiles. So if you put it next to another 100-year bond, and there are plenty of those out there, by the way, and I use the MIT bond as an example, those bonds basically go in at about 3% yield to maturity. Our modern Safehold ground lease portfolio generates about 5.2% yield to maturity. And as you guys know, and I think most of the folks out there should know, is that in that AAA CMBS world, when you can generate 10, 15, 25, 30 basis points more than your peers, you would be the best performing manager on the street. So that cash flow stream is one element of value. But in addition, there is the second component that's embedded with an investment in Safe, and that is that unrealized capital appreciation account, or UCA, which is derived from the value of the buildings that we will inevitably inherit. And to understand this component a bit more, think about this. When we IPO'd in June of 2017, we had $400 million of buildings that were going to be ours. And as of today, that value is now $6 billion. And every shareholder has a piece of that value embedded within their investment. And we're really going to spend a lot more time this year talking about UCA and why it's so extremely powerful, and particularly as Safehold's business continues to scale. And this UCA component is specifically why we believe that Safe's current stock price is extremely undervalued, because this element, we believe, is not presently being properly calculated in today's stock price.
Thank you, Ian. Very interesting stuff. Let me go ahead and shift gears here a little bit. On the surface of things, a REIT's a REIT, but of course that's really not the case. There is a lot of disparity, and a REIT is defined by, in large part, the assets in which it invests, and those assets are wide and varied. So on that note, let's talk a bit about cannabis. What are you seeing, David, among REITs in terms of interest in investing in cannabis-related assets, which brings its own sets of opportunities and, of course, challenges?
Sure, and the answer is immense demand that's out there. The first publicly traded REIT, the focus on cannabis was Innovative Industrial, IIPR. Yeah. They just announced their earnings a couple of weeks ago, and after they announced, they now own 73 properties across Arizona, California, Colorado, Florida, Illinois, Maryland, Massachusetts, Michigan, Minnesota, Nevada, New Jersey. Basically, any state where it's legal right now, they have properties. Total 6.8 million square feet. 2.4 million square feet that are being developed currently, and they have an average lease term over 16 years, meaning these guys are planting a flag for long-term relationships across all of these states. Another interesting company that's made a big pivot is a company called Power REIT. Their ticker is PW. Power REIT used to be like the railroad REIT, and in the past couple of years, they have converted towards controlled environment agricultural to grow cannabis and food production, as well as greenhouse and processing space. Plus, they also have a huge solar side of it. So they're taking on, again, the solar aspect, the cannabis aspect, and basically saying railroad, schmilroads, we're moving on to the next thing. Then we also just had recently in the past year the IPO of the first mortgage REIT to cover the cannabis space, and that's AFC Gamma. The ticker there is, I believe, AFCG. And so what you're seeing here is immense demand by the investors to invest in these public securities. But take an example of a place like California, Washington, Colorado, where companies are enacting cannabis tours. Come fly out to Denver and let's go on a pot tour. Let's go hit 25 pot shops and stay at the pot hotel and eat at the pot restaurant. I'm going up to the Northwest next week to go to a very famous concert venue to go see the rock band Phish. And I know that there's going to be a huge presence up in that area. And, another good example, talking about the publicly traded REITs, there's cannabis ETFs that are out there now. There's 7 publicly traded cannabis ETFs that cover the entire industry. So I think if you ask a lot of folks, the jury is still out, because folks will tell you we're still in the top first inning, maybe the top of the second inning when it comes to the cannabis game. There are folks that'll tell you, oh, we're so far down the path. But I think a lot of people are realizing, again, I'm a big believer in a lot of these interviews that I do, especially for the REIT industry, of, field of dreams. If you build it, they will come. And Innovative Industrial and Power and AFC Gamma and a lot of these other folks are perfect examples of, if they build it, they will come. Now, caveat. What if, when it happens that everything gets officially federally legalized and there's no issue? People are like, oh, that's the end of the cannabis REITs. Yeah. I'm going to take the other side of that bet. Again, they're the first movers. Think about Warren Buffettisms and being a first mover. Do you know how much it's going to cost just to start to raise hundreds of millions of dollars to go out and develop cannabis type properties? Whereas again, these guys already have, like I said, just under 10 million square feet by the time this is all said and done across, 20 states. They're the go-to person. They're the go-to company for development. So I feel like a lot of these people are going to realize, well, these guys already have the relationships with all these rosters of things. Hey, great example. Let's use MedMen. I know MedMen just got acquired by Tilray last week. MedMen has a relationship with Innovative Industrial. Let's say it gets federally legalized. MedMen's going to call IIPR and say, hey, do you guys want to build out our properties in Texas and in Wisconsin and in Arkansas and in Alabama for us? And the answer is, well, yeah, of course we want to. We want to be that partner with you because, again, like any other relationship, like EPR and Topgolf, let's go back to that example earlier. These guys were entering marriages. Think about it. We're not just building one. We're building 5, 10, 50, 100 over the course of 3, 5, 10, 20 years. It's long-term relationships that they're building on.
Yeah, David, one thing that's fascinated me, Zuber Lawler has been in the cannabis space as well as the real estate space for a very long time, over 15 years. So we're very, very familiar with all of the issues that you had mentioned and the opportunities. I've been amazed myself that there are so few REITs and other funds and family offices that are investing in cannabis assets. So as much excitement as there is, I'm a bit surprised that more haven't actually crossed that divide. And wanted to know, do you have any thoughts on that? Why is that? Why don't we see more taking the opportunity to earn what often are enhanced yields in the context of this subject matter?
It'll probably offend a bunch of folks with my answer, but I'll go ahead and say it anyway, because I was always taught if you have nothing nice to say it anyway. I think the answer is a multi-level response, and I'll just state the facts. Number one, I think it's the old school investor. It's the older type person that still thinks about cannabis being in the 1960s and it's an illegal vice. I think because a lot of these family offices and high net worth investors and these sophisticated guys have rules and mandates that are in place that say you can't invest in anything that's vice related. I used to call it sex, drugs, rock and roll, and gambling. If you're involved in any of those 4 things, you can't be involved in that as far as a certain family office type mandate and stuff. So I think unless you frankly kick out that regime of management or portfolio manager or somebody who's still stuck in the regime of the 60s and 70s, whereas if you go and talk to a 25-year-old portfolio manager today, he's going to be like, if I don't have cannabis in my portfolio, I'm underweighting this. Another great example is crypto. Look at the age discrepancy of crypto that's out there right now. And I know it's had a bunch of crypto panels that are on here, but buying crypto is like buying cannabis REITs. It's really not the easiest thing to go out and do. As of a couple of years ago, if you wanted to buy cannabis REITs, there was only one guy, and that was IIPR. As of a couple of years ago, if you wanted to go out and buy crypto, there really wasn't a publicly traded way to go and do that. But now I've got CNBC on my TV here, and every other commercial break is an ad for Grayscale, Coinbase, Galaxy, whomever. They're all pushing these products that are out there. And so I think what's happening is as we realize that there's more and more medical benefits of cannabis, as more and more states realize how much money did Colorado pay out to their tax holders because they made so much money in taxable revenue from cannabis last year? When they realize that all these monies are going out of the state and they can capture some of it, let me give you another great example. I'm sitting in Dallas, Texas. Gambling casinos are not in Texas. I can't go to a casino in Dallas, but I can hop in a car and drive an hour north and hit 2 casinos off the major highways at exit 1 of Oklahoma or exit 1 of Louisiana going towards the east. And guess what's in that parking lot? Every single car in that parking lot is a Texas license plate. So when's the government of Texas going to be like, guys, maybe we should start capturing some of this tax revenue instead of it going all out of state? And I think it's going to be the same thing. Guys, maybe we should start capturing some of this tax revenue from cannabis that these guys are generating in all these other states. But again, I'm in Texas. My running joke is we'll be the 50th state. It'll take the government to pass it before Texas passes it. But that's another conversation.
Thank you, David. There's so much there to mine, including diving into the crypto components of your response. But let me go back to Ian. Ian, I want to take a deeper dive into the returns on ground leases. It is, to me, it's exceedingly interesting that Safehold is so deliberate about tapping, I guess, something that hasn't been tapped in the context of financing by public markets, at least not in this deliberate sense. So on that note, can you define for us, or just dive into with a bit more detail, what are the components of returns of derived from ground leases?
Sure. So as I mentioned before, for our investors, there's really two components of value, and what we have done versus these old-fashioned archaic ground leases, which had these, Tom, these arbitrary rent resets. So, for example, this just happened in the Chrysler building. Under that ground lease, there was a point in time, and that was written into that ground lease, that the rent was going to go up X percentage based upon what they call the highest and best use, as you know, in real estate. Well, guess what? What's the highest and best use in real estate in New York? Well, that's co-ops and condos and things like that. So, long story a little longer, the rent in the Chrysler building went up 4 times, and guess what? It's going to go up 4 times again. So they, as you can understand, the people who are the owners of that, the tenants of that building, are in a very, very tight spot. So what we decided to do, and the whole idea was, historically, the folks who own ground leases really had one trade to make. They owned a piece of land, and they were like, okay, you want to build on my land, you're going to play by my rules. And I know I sound very New York by saying things like that, but that's kind of was the deal. And that's why they were written to be very one-sided. And by the way, if you're trying to go out and find a lender to give you a loan on your building that you want to do under a ground lease, and there is this uncertainty and ambiguity and that's built into the structure of your lease, you're going to get the worst term loan possible. So, what we did at Safehold is we said, okay, number one, this is not just one ground lease. When you invest with us, you're investing in a portfolio of ground leases, and we're going to strip away all of that uncertainty and ambiguity, and it's going to be very straightforward. 2% annualized compounding bump structures. Tom, just think about this. And David, I think you would agree. If I could tell you what your rent's going to be in 32 years, think about how good that would make you feel. But guess who it really makes feel better is your lender, right? Because they know exactly what they're going to be giving you, and you are going to get the best loan. So it's for our investors, this 2% cash flow stream that compounds is that first component of value that they get. And lastly, is what I just spoke about, and that we are spending so much time this year trying to educate the market on is what we call UCA, or unrealized capital appreciation, which is what we are going to inherit. Because remember what I told you, that at the termination of a ground lease, we get the building and all its improvements back as well. And the growth has been phenomenal. We are going to be one of the largest, real estate owners in the world if we keep on the pace that we're on right now. Because basically, every time we do a deal, that value of that building is going to revert back to us. And by the way, it costs us absolutely nothing because it's just part of the ground lease. So, as I mentioned earlier, we had $400 million worth of buildings that were sitting on top of the land that we owned when we IPO'd. And today that value is over $6 billion. That's insane growth, and you cannot ignore that. So, and the financial community has to, okay, they're going to say, look, it's way far out there. I'm not sure how to value this. And you can do an NPV calculation. And the calculation is inarguable. It's the inputs that you put into it. That could be whether it's the discount rate or the growth rate or whatever that may be, that could be discussed. So, what we are doing is, making these available to the audience who's listening to us today, to the individual investor. This is one of the most important things, and we'll maybe talk about that in a little bit. But the value derived for our investors really come from 2 places. They come from these cash flow streams, from a growing pool of ground leases. So every time we do into a ground lease, more rent and cash flow comes into us. We are a REIT, and we are, as you know, when you are a REIT, you are bound by law to pass through at least 90% of your taxable income back to your investors. But at the same time, we have this second component, which is this unrealized capital appreciation component, which is really this hidden gem that is the pot of gold at the end of the rainbow.
Good time.
Great stuff. Go ahead, David.
I want to add on one thing for all the folks that are listening today that Ian just touched on as far as the tax ramifications, 90% of taxable income being paid out to shareholders in the form of dividends. Unlike a lot of the other sectors, if you think about that little carrot that's right there, look at the REIT sector and look at the number of management teams and the amount of shares that those management teams own of those companies. Again, think about it. When you're talking about having skin in the game, and these guys are being paid based on performance, meaning if our stock price goes up, we make money. If we grow our revenues and grow our NOI, that means increased dividends that get paid out to our shareholders. Guess who's a shareholder? The CEO, the CFO, the AVP of investor relations in the top corner there. Again, as dividends grow, they get paid for it. So again, REIT sector is a perfect industry, one of those examples where management is truly out there working on behalf of shareholders because they want to see those dividends go up. Therefore, their compensation continues to go up as well.
Correct.
Very good. Thank you, David, for that add-on. Very valuable. And David, let's stay with you on that note. I really want to dive into cannabis and crypto more, but we don't have the time. I will make the note that I think that what you pointed to earlier is actually you're pointing to the opportunity, right? Because there's sort of this artificial veneer over cannabis and crypto, which is a function of a lack of understanding. But it really doesn't speak to the potential of assets within the cannabis space and within the crypto space to produce returns. So that within that sort of discrepancy between the perception of risk and actual risk, I think there lies true profits, which of course are very hard to find.
I mean, if Ian said there was trillions of dollars available in ground lease types of business, how many trillions of dollars are available in cannabis, aspects of the cannabis business?
That's right.
No disrespect to Ian, but I think the answer to the cannabis tide is multiple X of what we're looking at on the ground lease side of things. But again, that's just my opinion.
Yeah. And let's turn to net leases. Net leases have been performing well during COVID. Do you see them continuing to perform well post-COVID?
Sure, and that's a great question. And I love having this conversation because I always say, did you have your Starbucks this morning? Did you go grab your Dunkin' Donuts coffee? Did you happen to go pick up a prescription at the drugstore today? Because again, those are prime tenants for the net lease REITs. And unless you feel like Starbucks is going to be going out of business anytime soon, or your CVS down the street is going to be going out of business anytime soon, I would expect the net lease guys to continue to be on fire. Absolutely. Very good.
And why do you let's talk about Starbucks for a moment here. What is it about Starbucks, about that experience because typically what I had thought prior to COVID is that Starbucks is selling coffee. Certainly it looks like that on the surface, but what they're really selling, it seems to me at least, is an experience, right? You have the experience. It's part of your routine. You walk into that place before you start your day. You take a lunch, you take a break at 2:15 p.m. In the afternoon, and it's part of your routine. But for me, it wasn't just the coffee; it was the experience of just breaking up my day with that routine. So,
but Tom, the difference is your experience started here. Yeah. 5 years ago, if I'd said that you were going to order your Starbucks on this, walk in and it's sitting there waiting for you, now think about how that's blown up. It's all because of this thing right here, the cell phone. That's changed everything. But you're right. I think it's about the brand. It's the experience of walking in, getting the cup, and putting the little green plastic tip in of the stop or whatever it used to be. Sure, but look, it hasn't taken away Pete's out in your neck of the woods. It hasn't crushed Dunkin' Donuts or any of those other guys. I think you can't win everybody over.
Yeah, very good. Thank you for that. And being the only, I'd like to take it back to Ian for a moment. Ian, Safehold is the only publicly traded company that focuses on ground leases, right? Which is, I think, a notable fact. What property types does Safehold invest in, and what locations is Safehold most focused on?
Sure, that's a great question. So if you were to look at our portfolio today, Tom, it's primarily made up of office, multifamily, select hospitality. We do have some industrial. We do have student housing. I can almost say we are somewhat property type agnostic. We do not touch retail, so we will leave that out. I think, as David mentioned earlier, the Simons of the world certainly do a fine job in that space. But I think, to your point, and this kind of levies off of David's point about IIPR being the first mover, right? It's great to be the first mover in any business. And it's this whole notion of, and I think this is really specific to the audience who's probably listening to us today on this Benzinga Summit, is that we have made we like to say we've democratized ground leases. So what does that really mean? We have made ground leases available to the individual investor, and this is really, really, really important, because we have taken what was typically 100-year passive investment, and we have given it daily liquidity. So it's really remarkable, and we can all express our opinions on ground leases every day, and by purchasing safe stock through the public markets. And as I mentioned earlier, you're not just investing in one ground lease. You're investing in a growing portfolio of ground leases in many different property types in America's top 30 markets. So I think, to sum up of what we're doing, we are really revolutionizing real estate ownership by making it better. We're making it more efficient, and we're reinventing a big part of a $7 trillion industry by offering our customers higher return with less risk. And as I just mentioned, for the first time ever, we've made investments in ground leases available to the individual investor, you and I and everybody who's listening to us, an investment that provides principal safety, growing income through contractual cash flow streams, along with the significant opportunity for future capital appreciation.
Thank you, Ian. And Ian, is there any, I'm going to ask for a trick of the trade here. Sure. Is there any particular property type or location that is currently undervalued that folks aren't focused on enough in terms of the potential there for returns?
Yeah, that's actually a great question, Tom, because we say we're focused on the top 30 markets, and again, we like to call it NFL cities. So if there's an NFL team playing near that area, we are going to look at a ground lease there. And by the way, no disrespect to the folks in Dubuque, Iowa, we happen to like them very much. But I think we all know that well-located real estate is going to appreciate in value over time than real estate that's not well-located. So to get directly to your answer, Tom, is that, look, we all can think about those top markets, those gateway markets, the New Yorks, the LAs, the Chicagos, the Dallases. I wouldn't want to not include Dallas, particularly since David's on. But all of those top markets, but it's those high secondary markets, Tom, that are super important. And I can just tell you from a personal point of view, I grew up here in New York City. When I graduated college, I was able to live here in New York City. But guess what? I have 2 daughters in college right now. And when they graduate, they're not going to be able to live in New York or LA or San Francisco. Why? Because it's too expensive. So it's those high secondary markets that are extremely important. Remember, these are 99-year investments. So it's the Pittsburghs of the world, it's the Austins of the world, it's the Charlottes of the world. And Jacksonville and all of those places, look, they have great colleges, they have good jobs, and they're affordable. So those are the types of markets that we're finding a lot of opportunity, is those high secondary markets. Again, we have a very long-term view on these investments.
That was very helpful, Ian. A lot of valuable information there. Thank you. David, I'd like to come back to you to talk about government leased properties. Some general thoughts on how investors can earn dividends through government leased properties.
Sure. So for those that were on the presentation earlier today, they heard from the folks at Postal Realty Trust, PSTL. Postal Realty owns and manages, or on behalf of investors, post offices. And so unless you think that the U.S. Postal Service is going out of business anytime soon, that should be an interesting security to look at. The other security I always recommend when I talk about this is Easterly Government Properties. The ticker is DEA, the Drug Enforcement Agency. DEA, as of their last earnings report, they own 83 properties, of which 81 is leased to government tenants. That's right. The FBI, the TSA, the Food and Drug Administration, basically any government agency that has office space, they're the ones that are going out and buying those properties. So I always say, if you think the government's in danger of closing the FBI or the TSA or the Food and Drug Administration or any of those, maybe that's not the stock for you. But knowing where we're at, it could be a very interesting thing. So really, the rental payments that the government is paying to the company is being passed through to shareholders. Again, 90% of that in the form of taxable dividends. So I think DEA and Postal are two interesting ways to play the government.
Very good. We are officially out of time here, so I want to be a good moderator. I've enjoyed this conversation immensely. So let me, we have a few final seconds here, not enough for another question. Any final quick thoughts, Ian or David? I've enjoyed the conversation immensely and learned a lot.
Yes, I have a quick thought. Tom, on behalf of Ian, I wanted to thank you so much for spending the past 45 minutes moderating this great panel today. Without you, we wouldn't be here. So on behalf of Ian, thank you so much for doing this with us today.
I appreciate that, brother. Thank you, David.
I concur, Tom. Thank you for coordinating. It was lively, spirited, and it's always great to be with you guys.
Thank you very much, Ian. From all of us at Benzinga, really appreciate it. And to Benzinga, I'm always grateful to hang out with my friends here. So thank you very much for having us.